Hi there, welcome to Kneppy Invest, and welcome to me analyzing a company simply because I had one of their products. And that, of course, is Lindt chocolate. Yesterday, I had a bit of Lindt dark salted caramel chocolate, probably one of my favorite chocolates in the world. For some reason, it just works. And this is the chocolate I had. If I can find it here somewhere. Here it is. This one, sea salt caramel, has to be dark. Has to be dark. $8.50. Ew. They also have some balls as well. Anyway, so I was thinking as I was eating some of this excellent chocolate, whether I could buy or should buy some shares in this company. And I can if I want to, because I can buy Lindt. They're listed on the Swiss Stock Exchange. I can buy some Lindt through my super if I really want to. And I thought, hey, this would be good exercise in terms of what I look for in high quality investments. Anyway, so let's have a look at this particular company's financials. Now, they're called Schokoladefabriken Lindt and Sprungli AG. By the way, I have been to Switzerland and I actually went to a Lindt chocolate factory. They had tours. I forget exactly where it was, but a great little tour, and you got free chocolate at the end. Mwah, mwah, mwah. Anyway, the one thing I do remember about that tour is my ex-partner at the time was really upset because there was a school group coming through and they were making a little bit of noise. Anyway, but it was a good experience just going to the chocolate factory. Anyway, so whenever I am, by the way, price is a lot of money. Anyway, and whenever I look at a company for the very first time, I first focus on the revenue growth. Now, as soon as I see the revenue growth for Lindt chocolate, it's a little bit of a turnoff. Now, revenue growth over the last 5 years, 5.8%, over the last 10 years, 4.7%. I do prefer that to be a little bit higher. So that is the first little thing I've noticed. The second thing is earnings per share is a little bit better, 8.4% over the last 5 years, 6.3%. So maybe the margins have grown, or maybe they're doing share buybacks. But that sort of growth is not really what I'm looking for long-term investments. By the way, this company founded in 1845. There you go. Now, so after looking at the growth in the company, I focus on margins. I don't expect operating margins to be high, but they're enough. Now, this is the last year, 15.3% in the last year. I do prefer to look at a 10-year average, at least a 5-year average, just to see how margins are changing. Now, 15.3%, that's probably fair enough. That's probably fair enough. I'm not going to say that's bad. If it was below 10%, I would have been going, if it's above 20%, I would have been surprised with that. So operating margins of 15.3% sounds normal for this type of company without me being overly experienced analyzing chocolate companies. Return on equity, 13.4%. Return on invested capital, 10.1%. 5-year average. Return on invested capital at 10.1%, 5-year average tells me borderline high quality. So a lot of things I'm looking at here suggest that this company is borderline high quality. Probably lack of growth and return on invested capital probably right on that point where it transitions, a company transitions from high quality to low quality, or lower quality, or from lower quality to high quality. Now, I'd like to see return on invested capital be climbing. So we'll have a look at the history of that. And if it's growing, that would be a good sign. P/E ratio, 43.2. Okay, I would not be paying 43.2 based off what I see just now, but that could be distorted. That could be distorted. Maybe there was a one-off last year and profit was a little bit down. I doubt that just based off these numbers, but who knows? Dividend yield, 1.2%. So you're not in this for the income. And payout ratio, 53.9%. I would like that to be a little bit lower, but when I say that, I usually say that for higher quality, higher growing companies that are more focused on growth than anything else. Okay, dividend per share, by the way, is growing at a nice rate, about 7.5%, which is in line with the growth in revenue and earnings per share. Okay, now on to the financial history. So whenever I'm looking at a company for really the first time, I focus on revenue, and we'll have a look at income, and then we'll put in gross profit margins and operating margins. And we'll focus first on revenue and profit. And what I want to see here is revenue and profit growing through time. We already know that that's happening, but I just wanted to see how it's growing. For instance, maybe we wouldn't have, by the numbers, because we had 3 and 5 and 10-year history in growth, and just by that, I know it's more consistent than anything else. So we don't see any significant rise in profit or revenue in 1 year and then it levels off or anything like that. Or maybe the first 5 years there was growth, the last 5 years nothing, or no growth the first 5 years and the growth has come in the last 5 years. This has been a fairly consistent rise in revenue and profit over the last 10 years. Revenue has gone from 3.7 billion to 5.7 billion, and profits 380 million to 643 million. There was a little bit of a dip in 2020. For some reason, people weren't eating chocolates during COVID-19. I have no idea. But anyway, this is exactly what you want to see, but I would prefer it to be a little bit, the growth to be a little bit higher than this. So you might say that this company is more of a mature company, and mature companies probably don't deserve a P ratio of 43. Now onto margins. And what we want to see here is margins rising. Well, gross profit margins actually are rising a little bit. In fact, they've been all over the place, but generally between 64 and 67%, we'll say. And that's been true for the last 10 years. So I'll say margins or gross margins steady over the last 10 years. And I'm hoping to see a rise in operating margins. Oh, they were rising until last year. Actually, that's the last 12 months. We'll get rid of that. So it distorts it. So it is rising. There you go. So over the last 10 years, operating margins have risen, which sort of makes sense because income or profit has grown at a greater rate than revenue. And one of the reasons that can happen is if margins have expanded. It looks like that has happened for Lindt chocolate, 14.1% to 16.3%, with a bit of a drop in 2020. The next thing I'm going to look at is just return on invested capital and return on equity over the last 10 years, just to see. Now, the reason I'm doing this is, remember the return on invested capital was 10% average over the last 5 years. Now, that could translate to 4 years of 20%, and then there's 1 year it was like at 0% or something like that. And that's what I want to, that is what I'm looking for. Was there any weird year here that could have driven the return on invested capital or the return on equity lower than what it usually is, or higher than what it usually is? Anyway, so let's have a look at this. So this is return on invested capital and return on equity. Now, interesting enough, the last 2 years, nice. And they've been rising over the last 5 years. There was a little bit of low point in 2020, and then both of these metrics started to rise. But generally, if you do look at the last 10 years, return on invested capital typically is actually below 10%. It's only been above 10% 3 times, 2019, 2023, 2024. So you could say that with the last 2 years, that particular metric above 10%, that could be a sign that this company's quality is getting better. And return on equity up above 15% in 2023. And generally, it has been above 10% over the last 10 years, but just above 10%. So I still say that Lindt chocolate, based off these 2 metrics, is borderline high quality. Not the highest quality I've ever seen, but borderline high quality. Now onto P/E ratio. This one was interesting. It does look a little bit extreme. So let's just have a look at P. Oh. What is going on there with the P/E ratio? Don't like that at all. Yeah, there is no history. In fact, for some reason, we have no valuation metrics history here. I don't know why. It's just not happening. So we really can't look, based off this, we can't really look at the valuation history of this company. And what I like to look at is just to see or compare the valuation of the company right now to its historical range. And if a company, or say, if Lindt Chocolate's P/E ratio typically is 100, now it's 43, then my first question would be, why has there been such a high premium paid for this company? Just because of chocolate, maybe? But I would be surprised if that. I would assume right now the typical P/E ratio of this company would be like 20 to 25. So 43 does seem a little bit stretched. What else? Yeah, I don't think anything else here. We just don't have, for some reason, we don't have the history. The valuation history for this company. Oh yeah, so we can't really move any more forward. Okay, no chart. I'm gonna say that's it. That's all we have for this particular video. But the chart. So let's have a look at the weekly chart first. And what I'm going to do is put in the 200-week moving average. Now, sometimes you can draw on a conclusion when it comes to quality of company just by looking at the weekly chart and just comparing the weekly chart to the 200-week moving average. And in fact, this chart does show a high-quality company. but not significant growth, not some massive growth, but the share price has been increasing over time. And that is exactly what you want to see for a company you own for the long term. And in fact, when the share price of this company gets to the 200-week moving average, it usually is a good buying. We've seen that over the last 14 years, once, twice, 3, 4, 5, 6, 7 times. And that has been great buying opportunities for this company. Anyway, so I actually didn't expect this. Lindt chocolate has been we'll say a sound investment over the last 10 years. By the way, we can actually have a look at if we go to the overview, we can actually have a look at the total returns of this company. I am assuming returns of this company have been quite nice. Maybe 10, where is it? Total returns, we'll say the last 8.7% per year. This is total return. So this is share price increasing plus dividends. So 8.7%, would you be happy with that? I'm looking for greater returns than that. I actually expected that to be a little bit higher. And the main reason behind that is because a P ratio seems to be a little bit stretched. And sometimes when you see or think the valuation of a company is a little bit stretched, you might assume that the company has gone through a period of multiple expansion, and then that would translate to a greater CAGR than the growth of the company in terms of revenue and earnings per share. But we don't really see that. Slightly, but we don't really see that. Over the last 5 years, return 6.4%. Over the last 15 years, around about 11% per year. And over the last 20 years, 10.9%. So really, your returns in this company are only going to be, based off this, probably average from here on in, with a bit of downside risk just based off the PE ratio. Anyway, so at this point in time, even though I could buy shares in this company, I'm not going to, simply because of the valuation. Okay, that's all I have for this look at Lindt chocolate. I might buy some seed caramel, although with the increasing price of cocoa, chocolate prices have gone through the roof over the last few years. Or could buy 3 for 18. No, I'm not going to do that. Anyway, I only buy these chocolates when they're on special. I'm just like that. Anyway, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.